Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. The U.S. government shutdown appears to be nearing an end. Today is day 40, making it the longest in U.S. history. And now we are told a group of moderate Senate Democrats has agreed to support a deal to reopen the government. This is after the Senate released 3 government funding bills for the next year as a compromise, but none address the impending expiration of subsidies for the Affordable Care Act. We are told Democrats have secured a pledge by Republicans to vote on a bill to renew the Affordable Care Act tax credits by mid-December. Now, we're also being told that the Senate is set to hold a procedural test vote at midnight Eastern Time, and if that vote were to succeed, the Senate would still need the consent of all members to end the shutdown quickly. One senator can force days of delays and votes. And in a moment, we'll look at the impact of the shutdown on the U.S. economy with Chris Carey, his portfolio manager at Carnegie Investment Counsel. We begin this morning in Singapore with Bloomberg's Paul Dobson, our executive editor for Asia markets. Paul, thank you so much for making time. I'd like to begin with what seems to be a recovery in tech stocks across Asia after last week's sudden drop. What do you see happening?
So the market had a little bit of a crisis of confidence over the past week in terms of those valuations for the tech companies, for the AI related narrative in general, and whether we'd gone too far and the valuations were overstretched, which led to volatile trading, right? A down day followed by an up day and swinging backwards and forwards quite dramatically, and quite strong moves in either direction in the tech heavy Asia gauges, the Kospi in particular, but also Japan, Taiwan, seeing that kind of ebb and flow. On the one hand, you've got people that are saying that it's just time to take some profits here because the market has had such a strong run up and had gotten frothy. But the flip side of that is there are plenty more people waiting to buy any dip, hungry to just get in there and get these opportunities because they believe in that long-term AI narrative. And so that sort of tension has been playing off one against the other for much of the past week. It doesn't seem like it's completely resolved yet, but we are in a more positive mindset at the start of this week, it seems, from the early price action.
So I'm curious as to what analysts are saying. It's not unlike the situation here in the U.S. where you have an extreme concentration of these big tech names in the regional benchmarks. As a couple of examples, TSMC, I think, now accounts for over 40% of the TAIEX. And then if you look at the weighting of Samsung and SK Hynix in South Korea, together those stocks make up around 30% of the Kospi. Is this cause for concern?
Only if the trade unravels, right? I mean, you definitely have market concentration risks. And yet, like you said, it's the same in the US where the Magnificent Seven has been leading so much of the gains in the overall market this year. So yes, if the market turns against the AI narrative, then it will lead to a broader drag on gauges, and that could turn into a sort of self-fulfilling kind of a spiral lower because it would force people to liquidate, and maybe from the other parts of the market as well. I'm not sure, though, that it's an entirely negative thing because, we have seen such strong gains for so many of the markets, and particularly South Korea has been on an absolute tear this year. It's not only got the AI narrative, but it's also got the government behind it, almost egging it on. They want the Korea discount to disappear. They want more people to invest in domestic stocks. They want to smooth out all of the dysfunctions that have been there in terms of company ownership and favour shareholder interests more. So that has its own narrative as well, propelling it. And I think, region-wide in Asia, yes, the technology companies have been dominating, but there have been other positive narratives that have also been taking the market higher. And so it's even something that doesn't have a lot of tech in it, like the Straits Times Index for Singapore, has been continually setting record highs this year as well.
Over the weekend, China reported consumer prices unexpectedly increased in October. I think you have to point to the National Day holiday, right, in early October, that really was responsible for boosting a lot of domestic demand. Do I have that right?
It seems like that's one of the main contributing factors. And also, I think that the gold jewelry price has a disproportionate effect on it because obviously gold has been on this humongous bull run for most of the year. It doesn't change that overall narrative that China still needs to do more to beat this kind of disinflationary headache that it's grappling with at the moment. And we have a long story out there on the wire today that really digs into how all the prices of the goods that a regular consumer buys have actually probably fallen more than the official data would have you think. So, and it sort of gets at that idea that, you know, it becomes again a sort of self-fulfilling because as prices drop, wages drop, and then that kind of creates, you know, sort of like economic gloom basically. So still more needed probably to snap China out of that mindset.
I'm glad you mentioned that because at the end of the week we'll get the monthly activity data. Obviously that includes retail sales and industrial production. Do we have a sense of what we may learn at the end of the week?
Well, probably it's hard, you know, kind of to break this out. What I do think is interesting, though, is that for all that the domestic economy doesn't look super hot at the moment, China's financial markets have actually been having a pretty decent ride of late. You've got the yuan trading at the strongest levels for the year against the US dollar, but also against a bunch of other currencies on the crosses. It's looking stronger too. You've got stock market has seemed relatively resilient, and the tech story in China, the domestic stocks seem to be doing well because China set out this, you know, kind of very clear path where it wants more independence, it wants to be more self-sufficient, and it wants to push its industrial strategy as well. So that is helping actually the stock market. And then even on the bond side, so they did a dollar bond sale last week, and the bond yield that they got for it was on a par with US Treasuries and then traded through it in the secondary market. This week they're coming with Euro bonds, so it will be really interesting to see how that prices as well.
Also this week, the earnings, Alibaba, JD.com, and Tencent. I think that's likely to give us some more insight when you're looking at kind of the domestic demand story, right?
Yeah. It's crunch time. a lot of the market inputs are all coming together, and those will be interesting to tell us again, like you said, about the strength in demand in the domestic economy, and also, you know, I think the market will be looking to see what are they doing in terms of capex and in terms of AI development, because that's the sort of second part of the business model, and the one where the people are looking for the growth, I guess.
So before I let you go, Paul, later today the BOJ is going to release a summary of opinions from the October meeting. Are we going to learn anything about whether or not we are closer to, let's say, a December rate hike, do you think, from these minutes?
The BOJ is just so cautious, right? So we do know that there are some dissenters who are pushing for the rate hike to get done. And there's just a infinite amount of caution from the Bank of Japan, with good reason. You know, it's taken so long to get inflation going. They don't want to snuff it out, and they don't want to cause too many headaches for the rest of the economy, where growth isn't particularly hot at the moment. You've got the government talking about wanting to do more stimulus in order to create growth that's above government bond yield so that it can get down debt that way, which, you know, if it works out would be all well and dandy. But then, so that gives the BOJ that sort of background where if it wants to, it should be able to raise interest rates. But the problem is it also, you know, doesn't want to immediately head off any benefits that the sort of extra fiscal stimulus might do. So I don't know if we'll learn much more on that. I think they're waiting for more data, particularly on wage growth and whether that can remain resilient and robust. But, you know, our experience over the last year is that the Bank of Japan tends to chicken out. So if there is anything that comes along the pipeline that would discourage it in the meantime, then it would probably still err on the side of caution. All
right, Paul, thank you so very much. We'll leave it there with Paul Dobson, Bloomberg's executive editor for Asia Markets, joining from Singapore here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. And as I mentioned earlier, the U.S. government shutdown appears to be nearing an end. It's already delayed the release of 2 monthly employment reports, and this week's readings on both inflation and retail sales for the month of October will likely be delayed as well. Now, the absence of official data is certainly going to complicate the debate about whether another rate cut is needed. That will, of course, take place at the Fed's December meeting. Let's bring in Chris Carey. He is portfolio manager at Carnegie Investment Counsel. Chris, thanks for making time to chat with me. So as I mentioned, we have this key vote tonight at midnight, and maybe some positive momentum developing on ending the shutdown. But as I mentioned, we're still likely to be without official data. Is that the way you see it?
I wouldn't be surprised. We're pretty fortunate, though, that despite we don't know when the government shutdown is going to end, it's the longest one we've ever had in recorded history now. We're very fortunate that nowadays there are plenty of alternative data sources from third parties that have been able to give us a bit of an insight into inflation metrics, unemployment, so on and so forth. And I think now versus 10 years ago in this situation that we're sitting in, we'd be, there'd be a lot more uncertainty. It'd be a lot more difficult. So I'm pretty grateful from that. Who knows when we'll actually get that data? The Fed themselves has a pretty tough job, given the fact that for as long as I can remember, they're always saying how data dependent they are. Now there's no data. So it sucks to be them, but I'm not sure when we're going to get it, but it's definitely something that is top of mind for a lot of people. I think we're fortunate, though, that there's been a prolonged period of sub 3%, especially core PCE, which is the Fed's target measure of inflation. If we were in a much higher inflationary environment than that, and we were having the shutdown, I think it would be a lot more of a ding to investor confidence.
I'm curious to get your sense of the damage that may have been inflicted as a result of the 40 days that the government was shut down. New York Fed Bank President John Williams, in an interview with the FT, was focused on the financial strain among lower and middle income Americans. And he was basically saying, hey, that could threaten the resilience of the American economy. I think he has a point there, right?
Yeah, he does have a point, 100%. And it's those people on the lower end of the scale that need the assistance. And it's a real shame that they haven't been able to get that thus far. But also, conversely, you've seen that the vast majority of spending is by the top 10, 20, 30% of earners. And you really do see that for those, their consumer confidence, their sentiment is drastically different from those on the low end of the scale. And so companies that are able to benefit from those with larger wallets and more premium brands aren't really seeing any sort of impact to sales. But as I mentioned in the notes that I sent over to you, you're seeing that a lot of consumers are trading down, and that they're going to more value orientated products, and that companies themselves aren't necessarily always hitting the forecasts that were anticipated. As a result, that there's a lot of uncertainty brewing, and that as a result of that, they might be foregoing purchases or trading down. So I was, also saw that news before I hopped on here too, and so I'm hopeful that the shutdown does come to an end soon, as I think it will bring a lot of peace to many Americans, many consumers.
We can talk about the earnings portion in a minute, but let's talk about the wealth effect. To go back to that Williams interview, he was focused on acknowledging that wealthier households have indeed benefited from higher stock prices. Give me your sense of where the equity market goes from here. I mean, there's been so much optimism about productivity gains being driven by AI. There's also a lot of conversation around overinvestment and maybe even a bubble in pockets of the equity market. How do you view the landscape?
I'll never use the word bubble, given where we are right now. Just given that, I think when you use that word, that's based on the fact that the fundamentals just cannot justify what sort of an environment that we're in. And if we want to talk about certain portions of the market, Mag 7, for instance, the cash flows that they're generating far outstrip their capex. When that line intersects, and that's not the case, I think then we're welcome to have that sort of discussion. But even over the last 3-4 years, it hasn't been the case that we've seen. It's just been up and to the right the entire time. I think people's memories are very short, thinking back to April or to 2022, where Google, Amazon, other names got cut in half. The average since the 80s, the average drawdown intra-year in stocks is 15%, and ending the year typically would be up around 10 10.8%. We're up 14% so far this year. And most importantly, earnings have continued to do well. They've beat the average 10-year estimates in terms of earnings being higher, revenues being higher. We're through the bulk of this earnings season thus far. And it was the same story last quarter, where analysts were a lot more pessimistic. And there was an additional surprise to the upside. There's definitely some cracks here and there, especially in certain industries. And I mentioned that a little bit earlier. But overall, whilst it might be a little bit uncomfortable in the midst of it, it always is, but this is nothing all that extraordinary. Profit margins have risen from where they used to be previously as well. And so, from a PE basis, you could rationalize that, well, it does make sense.
Well, I was going to ask about that.
Expensive.
I mean, if you're looking at NVIDIA trading 55 times earnings forward to PE is something just under 42. If you look at the overall market on a historical basis, that seems pretty stretched, maybe a little expensive.
Yeah, exactly. And that's why these companies have to make sure that they can put up the results to show that the valuations are justified. I think of a handful of companies this earnings season that have got absolutely demolished because they haven't been able to put up the numbers. I think that's definitely a worthwhile concern. What is important for companies like NVIDIA is, okay, obviously they have their handful of core customers that continue to spend, but from then on, are actual individual businesses utilizing AI? And more importantly, are they continuing to renew those contracts with those companies? And I think overall business spending shows that they are. Ramp has, the company has great insights into AI spend within the economy, and our business is continuing to hold on to these contracts versus, they just try it out and see if it works. But contract values continue to increase, and you're also seeing that retention rates for software year on year continue to increase. So that's the first place I'd look. Once you see individual business spend starts to deteriorate, then I think that definitely opens up the question of, have we maybe misvalued or misjudged these companies? But so far they continue to put up record results, and that's reflected.
We're still in the early innings of adoption, right? But if you look at the end user for a moment, have we seen enough there on the productivity front to kind of warrant things?
I think so. I think in some areas it's not the case that we're taking large swaths of employees out of these companies and that AI is replacing their jobs, but I think you are starting to see more and more that these investments are paying off. It is slowly but surely. I don't think that this is going to be something by this time next year we're going to be in a radically different environment. But this moment, I don't think we're not off to the races, but there definitely does seem to be use cases for the software. I think even within my own industry, within my own job, there's plenty of ways that it's made myself more efficient in the things that I have to do on a day-to-day basis. And only a small fraction of employees at these companies are using it. And I'm not yet seeing any signs, at least from a business spend perspective, that it's not, that it's not rational.
So help me with an investment strategy. If I've been holding on to some of these AI names for a while and I've realized pretty terrific returns at this point in the cycle, do I want to maybe reduce my exposure a little bit? Are there other areas of the market that you think represent better value right now? I mean, what's the strategy that you're using?
I mean, ultimately, when it comes to our clients, it's you have an allocation that you're set to because you're dependent on these funds for retirement or whatever it may be, and so there's nothing wrong necessarily with taking a little bit of risk off the table and continuing to do so. And diversification, I think, has been more important than ever this year. Finally holding international stocks for the first time paid off. in many, many years that I can think of. And so I think that it's important to, from an investor perspective, if this was to get cut in half, as has happened for many of the Mag 7 names over the last couple of years, or in cases of NVIDIA, much more than half, would you be okay? How do you practice regret minimization in that respect? And so being able to take some off the table and diversify is necessarily a good thing. But it's a conversation you would be having during an environment like this where stocks are within 5% of full-time highs, not when they're down 20%. That's the wrong time to rebalance. But that's easier said than done.
Right.
But I mean, think back to April and think back to 2022 and think back to 2020 and 2018. Those were all horrific points in time to rebalance. And so for our clients, it's about being proactive, not reactive.
Okay, Chris, we'll leave it there. Thanks so much. Chris Carey is portfolio manager at Carnegie Investment Counsel, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.